You just checked your bank balance and noticed it's $12 lower than you expected. You scroll through your transactions looking for what you forgot to log, and that's when you see it. Maintenance fee, $12. You stare at your screen feeling confused and slightly annoyed because you specifically chose this bank because they advertised free checking. No monthly fees, the website said. Free banking, the commercials promised. But here you are, $12 poorer, and you can't quite figure out what you did wrong. My name is Minted Finance, and I spend way too much time thinking about how banks make money off people who think they're getting something for free. If you're someone who's tired of seeing mysterious fees chip away at your account balance every month while your bank claims to offer free services, hit subscribe and give this video a thumbs up, because what I'm about to show you is going to completely change how you think about where you keep your money. So let's talk about free bank accounts. Except here's the thing, they're not free. They've never been free. They will never be free. And the fact that we all keep calling them free is exactly how banks make billions of dollars a year off customers who think they're getting a good deal. Now look, before you think I'm just being cynical, let me be clear about what I mean. When a bank advertises a free checking account, what they're actually advertising is an account with no monthly maintenance fee, assuming you meet certain conditions. But that's very different from the account being free. It's like saying a gym membership is free as long as you work out there 30 hours a week. Sure, technically there's no membership fee if you meet that requirement, but the membership isn't actually free, is it? Here's what most people don't realize. Banks are businesses. They're not charities. They're not doing you a favor by holding your money. They're using your money to make money, and they're charging you fees on top of that. And somehow they've convinced an entire generation of people that this is called free banking. It's honestly kind of brilliant from a marketing perspective and absolutely infuriating from a consumer perspective. Let me show you the math, because once you see how much your free bank account is actually costing you, you're going to be mad at yourself for not figuring this out sooner. Let's start with the obvious fees. According to a study by Bankrate, the average monthly maintenance fee for a checking account at a traditional bank is about $15. Now, most people avoid this by maintaining a minimum balance or setting up direct deposit. Great, you avoided the obvious fee, you feel smart. But here's where it gets interesting. That minimum balance requirement, let's say it's $1,500. You keep $1,500 in your checking account at all times to avoid the $12 to $15 monthly fee. Seems reasonable, right? But what's that $1,500 earning you in interest? If you're at a traditional big bank, probably 0.01% annually. That's 15 cents a year. 15 cents. Meanwhile, if you had that $1,500 in a high-yield savings account, you'd be earning about 4 to 5% right now, which is $60 to $75 a year. You're avoiding a $12 monthly fee, which saves you $144 a year, but you're losing $60 to $75 in potential interest. Your free checking account just cost you at least $60, and that's before we even get into the other fees. Now, you might be thinking, okay, Nick, but $60 a year isn't that much money. And you're right, it's not life-changing money, but stick with me because we're just getting started. Let's talk about overdraft fees. According to the Consumer Financial Protection Bureau, Americans paid about $8 billion in overdraft fees in a recent year. $8 billion, that's billion with a B, and about 9% of account holders pay nearly 80% of those fees. Here's how this works. You have $100 in your account. You buy coffee for $5. You buy lunch for $12. You buy groceries for $90. You think you're at $107 spent, just $7 over your balance, so you'll pay one overdraft fee of about $35. Annoying, but manageable. But that's not how banks process it. Many banks reorder your transactions from largest to smallest, regardless of when they actually occurred. So they process the $90 grocery purchase first, which overdraws your account. Then they process the $12 lunch, which is another overdraft fee. Then they process the $5 coffee, which is a third overdraft fee. You just paid $105 in overdrafts on $107 worth of purchases. Your $7 mistake just cost you $105 because of how your free bank account processes transactions. Now look, I know what you're thinking. You're thinking you'd never let that happen because you track your spending carefully. Great, I believe you. But according to banking data, the average American with a checking account pays about 3 to 4 overdraft fees per year. Even if you're more careful than average, you've probably paid at least one. That's $35. Add that to the $60 you lost in potential interest, and your free checking account just cost you $95 this year. But we're still not done. Let's talk about ATM fees. Your bank has a network of ATMs where you can withdraw cash for free. Perfect, except their network is tiny compared to the number of ATMs out there. So when you're traveling or just in a different part of town, you use an out-of-network ATM. That costs you about $3 from the ATM operator, plus another $3 from your own bank for using an out-of-network ATM, $6 to access your own money. If you do this just once a month, that's $72 a year. Some studies suggest the average person uses an out-of-network ATM about 4 times per year, so let's be conservative and say $24. Add that to our running total, and we're now at $119 that your free bank account is costing you annually. Here's where it gets really interesting, though. Let's talk about what banks do with your money while it's sitting in your account. When you deposit money, the bank doesn't just hold on to it. They lend it out, they invest it, they use it to make money. And you know what they pay you for the privilege of using your money? Basically nothing. Think about it like this. You lend the bank $1,000 by keeping it in your checking account. The bank turns around and lends that money to someone else at 5% interest as part of a mortgage or car loan. The bank makes $50 on your $1,000. What do they pay you? 10 cents. They're making $50 on your money and giving you 10 cents. That's a 99.8% margin. Try finding that in any other business. Now you might be thinking, but Nick, banks have expenses. They have to pay employees and maintain branches and run ATMs. You're absolutely right. And you know what? They can afford to do all that and still make record profits year after year because they're not really giving you free banking. They're using your money to make money and then charging you fees on top of that. Let me give you a real example. A buddy of mine, let's call him Mike, kept his money at one of the big national banks for years. Free checking, he thought. He maintained the minimum balance, avoided overdrafts, mostly used in-network ATMs. Responsible guy. One day, he actually sat down and calculated what his banking relationship was costing him. Between the opportunity cost of his minimum balance sitting in a 0.01% account, the occasional out-of-network ATM fee, and one overdraft fee he'd paid that year when a subscription he forgot about auto-renewed, he'd paid $130 to his free bank in 1 year. So he switched, moved to an online bank that actually pays decent interest, doesn't have minimum balance requirements, reimburses all ATM fees, and doesn't charge overdraft fees. He kept the same amount of money in his accounts, same spending habits, everything. The next year, instead of paying $130 to his bank, he earned $75 in interest. That's a $205 difference from one decision. Here's the psychology part that nobody talks about. We think free means free because that's what the word means everywhere else. If someone offers you a free sample at the grocery store, it's actually free. You eat it and walk away. No strings attached. But in banking, free means free from one specific fee if you meet specific conditions, while we make money off you in 12 other ways you're not thinking about. And banks know this. They know that most people won't do the math. They know that most people won't read the fine print. They know that most people will see free checking and stop asking questions. It's the same psychological principle that makes people spend more with credit cards than cash. When you don't see the real cost immediately, you don't process it the same way. Now look, I'm not saying all banks are evil or trying to rip you off. I'm saying that banks are businesses. They're optimizing for profit, and they've figured out that advertising free checking brings in customers who then become profitable through other means. It's not personal, it's just math. But here's what frustrates me. You can do better math than they're expecting. Here's what you need to understand about modern banking. Technology has completely changed what's possible. 20 years ago, banks needed physical branches, lots of employees, expensive infrastructure. Those costs were real, and they got passed on to customers through fees and low interest rates. But today, online banks have minimal overhead, no branches to maintain, smaller staff, lower costs, and they pass those savings on to customers through higher interest rates and lower fees. This is where it gets interesting. Traditional banks are still operating like it's 1995. They're still maintaining expensive branch networks that fewer and fewer people actually use. According to recent surveys, something like 60% of banking interactions now happen online or through mobile apps. But those traditional banks are still charging you fees to subsidize the branches you're not even using. Meanwhile, online banks and credit unions are offering interest rates that are sometimes 400 times higher than traditional banks. Not 4% higher, 400 times higher. If your big bank is paying you 0.01% and an online bank is paying you 4%, that's literally 400 times more for doing nothing different except moving your money to a different institution. Now you might be thinking, but I like having a physical branch I can go to if I need help. Fair point. Do you actually go to a branch though? When was the last time you physically walked into your bank? For most people,